This is day 54 of researching a stock a day until I can quit my job. Today we're looking at Pagaya Technologies. There's a Warren Buffett quote, "Only when the tide goes out do you discover who's been swimming naked." With AI approved loans, we won't really know if the model is making better decisions until we have real pullbacks. A short volatility strategy looks great most of the time until it doesn't. In 2023, the company took a big loss on loans that suffered when the economy pulled back on the interest rate rises that started in 2022. Part of the regulatory rules is that Pagaya must retain a minimum of 5% of the loans they issue. Their retention is usually in the equity tranche, the riskiest portion, and the capital they put up for that equity requirement is levered. So they're holding the riskiest portion of near-prime ABS with leverage, which essentially means that Pagaya trades like a superpowered bet on subprime. Since 2023, they'll arguably have more data on which loans underperformed, so maybe their selection process has gotten smarter, but the high risk is a structural part of their business model. They hold the riskiest portion because it shows the ABS investors that they've got skin in the game and they believe in what they do. There's various assumptions, but a recession would likely wipe out a decent chunk of the equity tranches. And if you look at the math on Pagaya's exposure, pretty much all of the company's equity could be wiped out. If this reminds you a little bit of the 07-08 crisis, I wouldn't blame you. One of the benefits, but also one of the risks with private markets, is that not everything needs to be properly marked to market. I understand the business case. One of Pagaya's advantages is that it can analyze the data from lending across multiple different banks. Each bank is limited to its own customers, so they don't have as much data to look at. Because intertwining with each bank is quite intensive, it's harder for their customers to switch to another vendor, which is part of their moat. Bank tech is slow, and Pagaya has a lot of market it can participate in, and their revenue growth shows that. After the banks blew up the global economy in 2008,
people don't forget,
regulators made it more difficult for banks to lend, and this pushed people to borrow from other sources, which caused private credit to boom. The credit market is also tight, which means people are willing to take more risk and invest in these structures to get a bit more interest. I can see how the stock does well if the market continues on without any major hiccups, but I can also see the stock dropping by half or more in a recession, so I view this stock as an option, which means sizing accordingly. I've put a little bit of this on as it helps me participate if the party keeps going on without putting it all on the line. This is not financial advice. Always do your own research.